ACCA PM Grand Revision. Instructor is Rizwan Maniya. This is my WhatsApp number. You can message me for further PM support on this number and you'll be part of my groups. It's time to start the bird eye view of performance management. You should know who you are. You all are management accountants. When you go in your examination, the mindset that you have is of management accountant. So you know what work management accountant does actually performs? Yes, you should know. The management accountant does 4 types of things. What are those? Number 1 is planning. Number 2 is controlling. Number 3 is decision making. Number 4 is performance evaluation. Okay? So my friends, be very clear what I'm saying here. You need to repeat things with me, okay? You need to repeat things with me. So come on, tell me what 4 work does a management accountant does. Just give yourself the answer. Number 1, they plan. Number 2, they control. Number 3, they take decisions. Number 4, they do performance evaluation. Yes. Now let's start our game with planning. So when I say planning, so what exactly do management accountant in case of planning? So when it comes to planning, the first thing is you make budgets. Now budget is the best way to plan. You want to plan for the coming year, you have budgets. So the first work that you do is budgets. You make budgets. Now what kind of budgets do you make? Let's start with the first type of budget. The first type of budget is known as fixed budgets, okay? You know what is the purpose of making fixed budget? Very carefully listen. Fixed budget is the first budget for an organization. When you make a fixed budget, you will not change that fixed budget, which means the activity level at which you have planned the fixed budget, that activity will not change. Once you have made that, you will not change the fixed budget. So what is the purpose of making fixed budget? What is the purpose of making fixed budget? So the purpose of making fixed budget is number 1, to set the direction for the organization. The purpose is to set the direction for the organization, and number 2, to control fixed cost. Now, how I say direction for the organization? So it means that you have a plan for the coming year. It tells you that, for example, on 100 units, what will be your cost? What will be your revenue? What will be your profits? So it gives you a direction how things will look like in the coming year. Secondly, as I mentioned, it is useful for controlling fixed cost. Now the question is, why fixed cost? Because, listen my management accountants, fixed cost is a cost that should not change. So, if at 100 units you have figured out a fixed cost, it should not change technically. So, whatever the actual results will be, fixed cost technically should not change. But if there is a change in the fixed cost, then it means that there is some problem. So yes, then you control the fixed cost. So yes, this is clear. It is useful for controlling the fixed cost. Now, coming toward the second type of budget. The second is a flexible budget. Flexible budget is a one that is prepared at a number of different activity levels. Okay, this includes further budgets for the planning purpose, and it includes budgets for the controlling purpose. Listen very carefully what I'm saying. I'll tell you everything important about performance management, okay? So my friends, as I mentioned, that it is prepared at number of activity levels, which includes for the planning purpose and for the controlling purpose. So now, the most common thing that comes in your paper is it is used for controlling purpose, where you make a budget based on actual units, okay? Actual units. And when you make this budget based on actual units, so your selling price, come on, repeat with me. selling price, your variable cost, and your fixed cost will be of fixed budget. This means your cost and selling price will be of fixed budget, but your units will be actual, okay? Your units will be actual. So I hope this is clear to all of you. So flexible budget is a one that is used when you need to further plan the things, like worst case scenarios, like best case scenarios, and mainly you use this budget for controlling purpose, where you use actual units and you prepare this budget and you control with your actual results to see whether it's favorable or adverse, okay? So a very important hint, $1 million point I need to tell here. What is the $1 million point? Whenever I give you $1 million points, this means these are the points that will ensure that you do not do any mistake in your paper, okay? So flexible budget $1 million point says what? It says that when you're making a flexible budget based on actual units, remember to check whether cost is semi-variable or not. If the cost is semi-variable, so you need to remove the component of fixed with variable, which means, in short, you have to separate fixed and variable. When you separate fixed and variable, what happens? You know that variable costs will change with the number of units, whereas fixed costs will not change. So yes, you need to remember that you need to separate fixed and variable, okay? Moving ahead. The next budget that you prepare is known as incremental budget. Now, in incremental budget, the first thing is the definition. Remember, in your PM exam, it is very much highly likely that budget is tested for theory. Budget is one area which is tested a lot for theory in constructive response questions, which is CRQs, okay? So, you need to remember the definition of incremental budget. This is a budget that starts from the previous period actual result or the budget, in which you just need to justify two things. What are those? Come on guys, let's revise. Come on. Can you tell me what are those two things? Yes, number one, inflation, and number two, known changes. So yeah, inflation and known changes. Revise with me everybody, okay? So inflation and known changes. So you just need to justify inflation and known changes. Now the question is that when we use incremental budget, so let's check the suitability. It is useful in case of stable conditions. Yes. What do you mean by stable conditions? When you see that previous year is very much similar to the coming year, which means your activities are economic, your activities are efficient, your activities are effective, which means you can rely on your previous year for making the budget for the coming year, which means conditions are stable. In that case, you use incremental budgets, okay? So what are the advantages of incremental budget? Come on, are you able to recall the advantages? So the first advantage is that only increment needs to be justified, which means inflation and known change, which means it is very, very much time-saving activity. In small time, you can make this budget. Secondly, coming towards the drawbacks. What are the drawbacks of incremental budget? So my friends, drawback number one is previous period problems. The problems of the previous year will be shifted to the current year's budget. Yes, this is a big problem. So previous period problems might come into the current budgeting period. Okay. Previous period inefficiencies, uneconomic activities can easily transfer into your coming period. So this is a biggest problem of the incremental budgets. Okay. That is why we say when conditions are stable, when you can rely on previous year, then you use incremental budget. So the opposite of incremental budget is zero based. Are you getting my point, guys? What is zero based? zero-based budget is a one. If we start with the definition, so it says that it is a one that starts from a base of zero, in which everything needs to be justified right from the scratch on the assumption that the activity is being conducted for the first time. Yes, so a zero-based budget starts from a base of zero. It doesn't take any consideration of previous year figures, okay? So what are the steps of zero-based budget? Steps number one, define decision package or construct decision package. So do we know what is a decision package? PM students, you should know what is a decision package, okay? So decision package tells the purpose of the activity, consequences of not conducting the activity, okay? And it includes different alternatives of conducting the activity. So actually, decision package explains you what actually the activity is all about, okay? So first we prepare decision package for all the activities. Second step, come on, try to recap. Second step is evaluate and rank each package. So there are different packages that we will be getting, and we'll rank and evaluate each package, and according to that we'll decide the best one on the basis of cost versus benefit. Okay, let me repeat, cost versus benefit. So after done with the evaluation, cost versus benefit analysis, then we come towards the third step where we allocate the resources, keeping in mind the ranking that we have performed in step number 2, okay? Now, what are the advantages of zero-based budget and when they are suitable? So let's first recap the advantages. Advantages of zero-based budget includes that it results in efficient allocation of the resources. I'm sure you will agree, okay? Because everything needs to be justified. Secondly, it covers the major flaw of which budget? Incremental. As you just saw before, that incremental budget incorporates previous year problems, whereas zero-based budget will not. It will stop. There is a door outside zero-based budget where you will not allow to enter previous year figures. So all inefficiencies of previous year will not be allowed to go into the next period. Agreed? Further, it results in better allocation of the resources, plus staff motivation will increase. Why? Because every manager will make their own decision package. Canteen manager will make their own decision package. Maintenance manager will make their own decision package. So everybody will make their own decision packages, which means, my friends, staff involvement will increase. Because they are making their own packages, they will be very much motivated achieving them. But when it comes to flaws of zero-based budget, what are the problems? There are serious problems. Number one is it time consuming? Come on, say yes or no. So yes, is it time consuming? Yes, it's time consuming. It takes a lot of time because you need to make packages, because you need to rank them. Yes. When I say rank, other drawback that comes in my mind is ranking may be subjective. Ranking can be subjective. So what is subjective? Maybe when there are two activities and the benefits of those activities are of qualitative nature, which means ranking might not be appropriate because qualitative is something which you cannot measure, okay? So yeah, it can result in wrong rankings. Third, it will require skills. Skills for whom? Managers, because they need to construct decision package. So we need to train them. We need to give them the skills to prepare decision package. So yes, keeping in mind the drawbacks, then let's discuss when it is suitable actually. So my friends, it is suitable in case of discretionary cost. It is suitable in case of public sector organizations. Why public sector? Because public sector are normally not-for-profit organizations, and not-for-profit organizations' ultimate objective is not to earn profit. So their purpose is to control cost. And if you want to control cost, zero-based budget is the best answer for that, because everything needs to be justified before being included in the budget. Okay, perfect. Now, let's move on towards the next budget, which is known as rolling budgets. Rolling budgets, okay? So, my friends, rolling budgets is a one, if I start with the definition, is a one that is prepared in uncertain situations. Which means, if someone asks you, define rolling budget, so you will say, it is suitable in case of uncertain situation. You prepare this budget when there is lots of uncertainty around. What is uncertainty? Sir, please explain what is uncertainty. My friends, uncertainty means that interest rate is changing every 3 months, maybe monthly. Exchange rate fluctuation is a lot. Okay. Demand supply condition is changing. Yes. So this is uncertainty. So my friends, listen. A very good connection. When there is lots of uncertainty, so making fixed budget is useless. Making fixed budget is useless because when you make the budget, by the end you get to the end of the period, things have shifted so much. Things have changed so much that this budget will become obsolete. So the answer is make rolling budgets. What rolling will do? Your 12-month plan will be broken down into months or quarters. Now what you do? Detailed planning is done for the immediate period and less detailed planning is done for the remaining period. Okay, so I hope you are able to remember what I'm trying to emphasize. The diagrams that I made in my webinars, in my regular online classes, so you can recap those, right? So, detailed planning is done for the immediate period and less detail done is for the remaining period. As the first period expires, what will you do? Come on guys, try to recall. As the first period expires, you will add another period into the budget, okay? You will add another period into the budget. What else you do? You compare this period actual results with its budgets and you get what? You get variances. So all the uncontrollable variances which organization cannot control, which are outside the control of the managers, all those changes are incorporated into the current period. Budgets are incorporated into the coming period budgets so that all the market conditions are incorporated into the coming period and make them up to date, okay? And make them up to date. So yes, you need to keep this in your mind. This is how rolling budget works out. So what are the positives of rolling budget, okay? So as you just saw, as you just heard, as I said before, that all the market changes which organization cannot control are incorporated into the coming budgets, which means advantage number one is your budgets will become up to date. Your budgets will be realistic. And when you have a realistic budget, you are more motivated to achieve it, right? But at the same time, there are certain threats. But at the same time, there are certain drawbacks. What are the drawbacks? Can any one of you tell me? So the drawback number one includes time-taking activity, time-consuming activity. Every time as the previous period expires, you have to add another period. As the period expires, you have to check that with the actual results and incorporate the changes. So a lot of time-taking activity. At the same time, there is a big danger. And what is that? Because you are so much involved in making the budgets, adding a new period, incorporating the changes, you might not have the time to control actual result. You might not think, okay, I have to control actual results as well. Because my friends, my management accountants, my VIFHEians, remember that the purpose of budgets is to control the actual results. And you might not get the time for that. Okay? So yeah, these are rolling budgets for you. Now, coming towards the last budget, that is activity-based budgets. Okay? So activity-based budgets are very much connected with overheads. So overheads, now what are overheads? The indirect cost is known as overhead. So what is indirect cost? Come on, do you know that? Indirect material, indirect labor, indirect expenses, all are indirect costs. So this is basically making budgets for different activities which actually give rise to overheads. Like inspection is an activity which will give rise to overheads. Like material handling is an activity which will give rise to overhead. Like setup is an activity which will give rise to overhead, which means you are making budget for material handling activity, you are making budgets for setup, you are making budgets for inspection activity, and this is activity-based budgets. Okay, so what are the advantages of making budgets for these overhead activities? It's very simple. By making the budgets, you will know how much cost you expect to incur for setup in the coming year, how much cost you expect to incur for inspection cost in the coming year, and then you can compare this budgeted cost with the actual cost that you have incurred. And once you do that, you get to know the difference and you can compare and you can control that. Okay, so yeah, it's lot advantageous for you comparing the budget with the actual result. But at the same time, my friends, million and billions of overheads are associated with a company, which means that breaking those overheads into lots of activities and making budgets for each will be very, very time consuming. So this is the negative aspect of that. So I hope this is clear to all of you. And 6 types of budgets have been covered here. So my friends, my management accountant, come on, what do you think? Whatever I have just given you the recap of is all relevant for you. Come on, say yes or no in the comment box. Okay, so yes, you can see here fixed, flexible, incremental, zero-based, rolling budgets, and activity-based budgets. This comes under the heading of planning work that is done by the management accountant. In the comment section below, just give me feedback up till now. What do you think? Is the summary effective for you? Come on guys, say yes or no. Okay, so now if I move ahead, so the other planning aspect that comes in budgets is to understand the systems of planning. This system of planning means that what is strategic level of planning, which is for the long term, 3 to 5 years, what is tactical planning, which is medium term planning, which is yearly planning or a monthly planning. Then comes the operational planning, which is day-to-day or a weekly planning. Under this budget system comes different approaches of budgets like top down. What is that? Top management prepares the budget and just surrenders that to the lower management. Hello, you have to achieve this. Lower management says, we cannot do this. Top management say, no, you have to do this. It's top-down budgeting style. And then comes the opposite is bottom-up. What is that? Lower management prepares the budget and then submits that to the higher management. And like this, it is known as bottom-up budgeting, where there is lots of participation involved. Then comes the in-between thing between these two extreme is negotiated style, where both the parties sit and negotiate and reach to an outcome. Okay? After this, we have another important thing, and that is learning curves. So yes, what is learning curve? Learning curve is extremely important for your PM examination, my friends. My management accountants, remember that learning curve can become part of any question, whether it's ABC, it's life cycle, it's a target costing, it is a variance question. Yes, learning curve can come anywhere because learning curve relates to labor. And what is the concept? Just recap the concept. The concept is when the labor performs the activity for the first time, labor will take the highest time, okay? Highest time. But due to repetition of the work, he gets to understand more things easily, he understands the shortcut, and due to this knowledge and experience, his time gradually is getting down and down and down and down, and the time will come when the time will become constant, and the time will come when the time will become constant, which means that after that there will be no learning. One very important question that comes in the paper is where you are required to figure out when the learning will stop and what time it will take to make the next unit after the learning has stopped. So it's very simple. Let's quickly recap. Just imagine if learning will stop once 200 units are completed. Once 200 units are completed, learning will stop. The question requires you to calculate the time per unit after 200 units. After 200 units. Come on, guys. Let's recap with me. Just think what I'm saying. How will you calculate the time per unit after 200 units? Come on. Just mention the comment section as well. So how will you do that? It's very simple. You will first calculate the total time for 200 units. Yes. Then you will calculate the total time for 199 units. Yes. And then what you'll do from the hours of 200 units, you will deduct the hours of 199 units, and then you will get the differential, and that differential will be the time for 200th. What I'm saying? 200th unit. So that will be the time for 200th unit, and that time is a one that will be applied to all the units that you will produce after 200 units. Okay, so very common working. You can see in the summary there is a format given here. So my students, my webinar students, my regular online VIFHE students, everybody knows that what is the format of learning curve. So there are 4 things to consider. Number 1, cumulative units. Number 2, cumulative average time. Number 3, total time. Number 4, incremental time. So what calculations you need to perform? So the calculation you need to perform relates to cumulative average time. This cumulative average time you can work out through both methods, through 2 methods. One is, which one, guys? Double approach. Second is log approach. You can use any of the methods, but it's preferred to use log approach because log approach doesn't have the limitations of that double which double approach has. Okay. The last thing, there are certain questions in the paper where you need to work out the learning rate. You are not given with the learning rate like 90%, 80%, 70%. There is no learning rate. So what to do, what to do, what to do? My friends, don't worry. You have a very simple solution, double approach. Through double approach, you can work out the learning rate. So whenever you are required to find out learning rate, double approach is the solution for you. Before I move towards the next one, the last thing that is coming in my mind relating to budgets is number 1, feed forward control. What is feed forward control? People do get confused in feed forward control. Feed forward control means that before the actual, you control the results to ensure that it doesn't end up in an adverse result. Feed forward control means that before something has arisen, before that you try to control it. The best example of that is target costing. Target costing, we'll recap that later on as well. But feed forward control means that before something happens, you control so that it doesn't result in an adverse thing. A quick one. If today you are revising and your paper is very near and you think that your preparation is not good before the paper, and you know that if you will not cover up things well, you end up in a failure. So Before your paper, you start making new systems and procedures and you start working hard, and this is all what you're doing so that your result is not adverse. So this is feed forward control. Before your examination, you're trying to improve your result is feed forward control. My friends, this is clear to everybody. Now the last point is beyond budgeting. What is beyond budgeting? So the concept of beyond budgeting is that budgets are outdated. Budgets are time consuming. Budgets results in manipulation. Budget results in dysfunctional behavior. Through budgets, people give importance to their own objectives. The concept of beyond budgeting says that think beyond budgets. Come out of the boundaries of budgets. Don't think about annual result. Think long term. So beyond budgeting is a philosophy that says that we should not restrict ourselves to annual budgets. Rather than you have to cover the long-term perspective of an organization. So this is budgets for management accountants. The first work that we do is what, guys? It's the planning work, okay? And this includes the entire stuff. Now let's come towards what? The controlling aspect. The second work that is done by the management accountant is controlling. So guys, are you ready for controlling? Okay, yes, in the comment section if you are. I want people to be interactive. While watching the summary, you have to be energetic the way I am right now, okay? So, the second work that the management accountant does is controlling. Okay, so now let's begin with controlling. The second work that is done by the management accountant, guys. So let's start with controlling. Once you plan, you make budgets, you get the actual results, you compare that, okay, with your actual result, and that is controlling. So yeah, you need to remember when it's controlling, you work out variances. When you get the difference of budget and actual, that is variance. So first of all, let's recap the basic variances. Basic variances, which means the variances that you have covered earlier in your previous paper of management accountant, includes, come on, can you recap with me? It's material price variance, material usage variance, labor rate variance, labor efficiency variance, idle time variance, variable expenditure variance, variable efficiency variance, fixed expenditure variance, fixed capacity variance, fixed efficiency variance, sales price variance, sales volume, profit or contribution variance, okay? So out of all these variances, a big list. The important for PM are material related, labor related and sales related because these are connected with advanced variances. So let's start first with material mix and yield. So you all know what exactly material usage variance is. So let me give you a quick recap here. My friends, my management accountants, material usage variance does what? Material usage variance is a comparison between your actual quantity of material that you have used and what you should have used, which means what was allowed to you and what you did use, which means in very short, your father said to you that you have to spend, you are allowed to use 5,000 rupees or dollars and you did use 6,000, okay? So this is same for material quantity variance, material usage variance, that you compare what you have used and what you should have used. This is usage variance. Now remember very clearly, coming towards the definition here, material usage variance is broken down into mix and yield when there are two conditions. Remember, come on, try to recap with me. There are two conditions. If you fulfill these conditions, then you are allowed to divide material usage variance into mix and yield. Condition number one is more than one material is used. Come on, more than one material is used. Second, and the material are interchangeable. Yes, material are interchangeable. So if this is the case, you break usage into mix and yield. Having said that, my friends, having said that, now try to understand what I'm saying here is you break this into mix and yield. Now what is a mix variance? Material mix variance, a quick definition recap. Material mix variance is a difference between standard material mix and actual material mix. Standard material mix and actual material mix. So it's a difference between standard material mix and actual material mix, okay? What is yield variance? Yield variance is a difference between, but before I tell you the difference, I need to tell one thing to clear out the confusion. Yield variance is the one that you can work out using input method and you can even work out using output method, okay? Both will give you the same answer, okay? Both will give you the same answer. But technically if I say yield means output, okay? But you can even work out using input method. So by definition, if I tell you, yield variance is a difference between standard output and actual output. The output that you should get and the output that you have. If I explain you this in terms of input method, so I would say it's a difference between actual input used by the organization and the standard input that they should have used. So this is yield variance, okay? Now comes the very important thing. And what is that? What is that? Very important thing. And what is that? Which is calculation of the variances. So there is a formula, there is a 5 column table that you can follow for mixed variance and you can work out using that. So what is that 5 column table? A quick recap here. So what we do here first we start with the we start with material actual input, which is divided into standard mix. We compare that actual input with actual mix. We get the difference of the quantity. We multiply that with the standard cost per kg or per liter and we get the cost variance. How do we work out yield variance? Okay, so how we work out yield variance? So the first column we have is standard input and standard mix. The second column is actual input in standard mix. The third is quantity variance. Fourth is the cost per kg or liters. And fifth is cost variance, okay? Now coming towards the reason for variances. Come on, can you recap, guys? Why mixed variance is favorable? Can anyone tell me why mixed variance is favorable? Just write in the comment section why this is favorable. So very quick one, okay? This is favorable because when cheaper material has been used more and expensive material has been used less. Cheaper used more, expensive used less. This results in favorable mixed variance. Yes, this results in cost saving. And why this is adverse? It's the vice versa. So what is the vice versa? Expensive material used more, cheaper material used less, and this results in adverse mixed variance. Agreed? Okay. Now coming towards yield variance, can you just recap and tell and write in the comment section why yield is favorable? Okay. So listen friends, yield is favorable, number one, because what is the reason? So the reason is that expensive material is used more, expensive material used is more, and cheaper material used less, which means because expensive used more, so less wastage and more output. So that's the reason for yield being favorable. Reason number one. Reason number two, good control over the production process resulted in less wastage and more output. You just make this vice versa, it will make yield adverse. So when yield is adverse, possibility number one, expensive material used less, cheaper material used more. Now, when you use more cheaper material, what happens, friends? Obviously, there is a chance of more wastage, and there is more wastage, so less output. So yes, this is adverse. One reason was this one. Second is poor control over the production process resulted in lower output and more wastage. So this is yield for you. Now there is a concept of interdependence. Do you know what is the concept of interdependence? Very simple. When one reason is making one variance favorable and the same reason is making other adverse, this is interdependence. So you need to figure out interdependence. Let me repeat it. What is interdependence? When one reason is making one favorable and one adverse is interdependence. Okay? Which means that you bought a cheaper material of lower quality. So what this will do? It will make your price variance favorable, whereas it will make your usage adverse because it was a poor quality. So this is material mix and yield. After this, we have the second one known as sales mix and quantity. Are we getting the recap completely? I think we are. So sales mix and quantity variance. My friends, have you heard about sales volume variance? I'm sure you have. You know what sales volume variance is. So sales volume variance is what? Sales volume variance is a variance that compares your budgeted volume with your actual volume. Whether you have sold more units compared to what you have planned. This is sales volume variance. So do you know when we break volume into two parts? Do you know that? When we break volume into two parts, we break volume into two parts of mix and quantity when more than one material, I beg your pardon, when more than one product is sold. Secondly, products are interchangeable. Okay, you know the condition, interchangeable. So when you are selling more than one product and those are interchangeable, then yes, in that case, you go for sales mix and quantity. Okay, my friends. Now, do you know what sales mix variance indicates? Okay, this indicates the difference between standard sales mix and actual sales mix. So it's a mix difference. Okay, what quantity indicates? Quantity indicates your total actual units that you have sold and the units that you had planned to sell. It's the quantity planned to sell and what you have sold. So this is a sales quantity variance. Okay. Now, as I said, sales mix variance is a difference between standard mix and actual mix. So let's discuss the reasons why sales mix is favorable. Come on. Can you think about the favorable reasons of sales mix variance? So yes, we have when high profitable products are sold more and low profitable products are sold less. Come on, you can write in the comment section, okay? When high profitable products are sold more and low profitable products are sold less, that results in sales mix variance being favorable. And what's the vice versa? It's very simple. When high profitable products are sold less and low profitable products are sold more, so mix has changed. So this results in adverse sales mix variance. Agreed. Coming towards quantity. Now, do you know the reasons for sales quantity being favorable? Sales quantity being favorable. So yes, you should know. Reason number one, it could be favorable because of decrease in prices. When the price goes down, quantity increase. This is interdependence. Price goes down, it makes sales price variance adverse, whereas it makes sales quantity variance favorable. Secondly, favorable market conditions are favorable in the market. Number three, successful marketing that you have done. Number four, good quality product you sold in the market. These are the reasons for making sales quantity favorable. So why this will be adverse? It's vice versa. What is that? Increase in price. Number two, poor quality product. Number three, unsuccessful marketing. Number 4, unfavorable market conditions will result in quantity being adverse. Okay. Now moving towards the third very important group of variance. And what is that? Planning and operational. So why do we work out planning and operational? You can see management accountants, a summary is in front of you. It is giving you a bird eye view and you can relate the things together, right? So yeah, planning and operational. Why do we work out planning variances? We work out planning variances when we think there are errors in setting the standards. When you think that standard that you set was wrong, when you think the standard that you set is something not appropriate, so you break the variance into planning and operational. So what planning variance does? You know that? Planning variance will highlight the planning errors, okay? What operational variance does? Operational variance will reflect the real performance of operational team. Who is part of this operational team? It's the sales manager, it's the production manager, it's the purchase manager. These are all part of operational team. So remember, VIFHEians, planning variance tells you the planning errors. Operational variance tells you the real performance of the operational team. Because if operational team like sales manager, production manager, purchase manager are not responsible for setting the standards, and if standards are wrong, then they are not responsible for that. Then they are not responsible for that. So this is your planning and operational variance, okay? So guys, just write in the comment section, is the feedback good? Is the summary going good? Can you recap the things quickly? Come on, tell me in your comment section. Your feedback is important. It is giving you a good recap of everything, right? So, as I was mentioning, my friends, that planning operational variances are a one that we work out because we need to separate the planning errors with the operational ones. That is why you calculate planning variances and operational variances, okay? So the error in making standards can come in case of material. So we'll break material variances into planning and operational. The error can come in labor. So we'll break labor into planning and operational. And the error can come in sales. So yeah, we'll break sales into planning and operational. So you just have to look in the question whether there is any planning error. If there is, you need to just split that into planning and operational. Now, the $1 million thing. And what is that? When you are calculating planning and operational variances relating to material and labor. Why material and labor only? Because material is a cost, labor is a cost, which means whenever you are calculating planning operational for cost variances, so remember Rizwan Maniya $1 million technique, and what is that? It's O versus R for planning and it's R versus A for operational, okay? So remember the $1 million technique, which means when you're calculating the operational variance for material, for labor, so what you have to do? You have to use the technique, what is that? R versus A. What is R? Revised standard minus actual result. Revised standard minus actual result. When you're calculating planning variances, so what you need to remember, guys, it's O versus R. Original standard minus revised standard. So planning variance is original standard minus revised standard, whereas operational variance is revised standard minus actual result. But remember, this is for cost. When it comes to sales planning and operational, so you'll make this vice versa, and what will be the case? So if you're working out operational sales variance, which means you will be taking A versus R, actual results minus revised standard. And when you're calculating planning sales variances, so again it will be vice versa, revised standard minus original standard. So that is R versus O for planning and A versus R for operational. Okay. When I say revised standard, so what is that? So listen now. Remember the rule of URO. Remember the rule of URO. What is URO? Listen, when you are reading a question in the examination, so while reading the question, try to figure out U. What is U? Uncontrollable factors. Wow, it's so simple. Remember U. What is U? Uncontrollable factors. So try to find out uncontrollable factors. Now, uncontrollable for whom? Uncontrollable for whom? Remember O. What is O? Operational management. Uncontrollable for operational management. Who is part of operational management? Who is part of operational management? It's production manager, it's sales manager, it's the purchase manager. Okay, so these are part of operational management. So find out uncontrollable factors for these. For example, inflationary rise. This is out of the control of the production manager, purchase manager, sales manager. Yes, it is out of the control of operational team. Another example, a customer request. Customer request resulted in changing specification. This is not under the control of operational team. So, while in this scenario, find out uncontrollable factors for operational management. And once you found that, very quickly revise the standard. Very quickly, ours is what? Revise the standard. Very quickly revise the standard. That is, you need to revise the standard. We need to revise the original standard because these factors are not in the control of the operational team. So the rule of URO is applicable whenever you are reading the question. So what are you supposed to do, management accountants? Tell me. Find uncontrollable factors. Once you found uncontrollable factors, what you have to do? Come on. What you have to do? You have to look uncontrollable for operational team and quickly revise the standard. So once you revise the standard, now you will get original standard that is given in the question. Listen what I'm saying. Then you will have revised standard that you have done the revision because those were uncontrollable factors. And then you have actual result. Remember, original standard, revised standard, actual result. And after that, it's piece of a cake. Why? Because you have my rules. R versus A, O versus R for cost, original versus revised, revised versus actual. This is for cost. And you have rules for sales. So what are those? A versus R and R versus O. So I hope you are getting my point, and it's very simple in case of cost and sales. Now, having said that, what are we supposed to do? So friends, what are we supposed to do? As I mentioned, U is what? U is uncontrollable. R is what? Revise the standard. O is what? Operational management. So whenever you are reading the scenario, remember my $1 million statement, that is URO. Find uncontrollable factors for the operational management and then revise the standard quickly for all those factors which are not under the control of operational team. Now when it comes to theory, so what are we supposed to do? Whether it's sales mix quantity theory, whether it's material mix or yield theory, whether it's planning operational theory, remember my $1 million technique that I've explained in my ACCA webinars since so many years in my regular online classes. It's the shortcut known as CRIC. Come on guys, it's the shortcut known as CRIC. What is CRIC? The first C is calculate the variance, What is R? Reason. Find out the reason for variance. Whether it's favorable, it's adverse. So find out the reason. Why it's favorable, why it's adverse. Remember, if you have material usage variance adverse, reason is not, it's adverse. This is not reason. You have to find out why this is adverse. So reason means why. And from where will you find why? You will find from the scenario. It should be scenario based. So just look at the scenario, find out the reason why adverse, why favorable, okay? So the rule of Crick is what? Calculate the variance. Number 2, reason. What is reason? Find out why favorable, why adverse. And then I. What is I? I is interdependence. What is interdependence, guys? A simple statement. What is interdependence? So remember, one reason making one favorable and other adverse. One reason making one favorable and other adverse is interdependence. So when you are writing theory, when you are drafting answers, look at the variance. Calculate the variance. Then find out the reason. Reason is what? Scenario based. Then find interdependence. Interdependence. And then the last C is conclusion. 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 Okay. So interdependence is what? One reason is making one favorable and other adverse, and then you conclude. Okay. So whenever you have to write the theory, whether it's mixed yield, mixed quantity, planning operational, remember Rizwan Maniya, $1 million theory technique, Crick. Okay. So this is controlling. Now let's see the other work that management accountant performs. Management accountant does planning. Come on, write in the comment section what management accountant does. Planning. What management accountant does? Controlling. The third work that is performed by the management accountant is what? Is decision making. Yes, decision making. So the third work that is done by the management accountant is decision making. Guys, are you all with me? You need to write in the comment section by saying yes, you are listening me, okay? So the third important work that is performed by the management accountant is decision making. Decision making. So what decision making is? What is decision making? So let's now understand decision making. Now, because you are a management accountant, you need to take decisions. You need techniques for that. So what kind of decisions you are talking about? Is it the long-term decisions or the short-term decisions? No, I'm talking about short-term decisions. So what are short-term decisions? Number 1, linear programming. What is this? Listen guys, be with me. Listen guys, be with me. When there is a limiting factor. What is a limiting factor? I'll give you a very good recap. What is a limiting factor? When there is shortage of labor hours, when there is a shortage of machine hours, when there is a shortage of material, it's a limiting factor. So what happens if there is a limiting factor? Remember management accountants, if there is a limiting factor, this means that organization cannot achieve profit maximization. Yes, guys, say yes in the comment section. So yes, if organization cannot achieve profit maximization due to certain factors, due to shortage of certain factors, that is limiting factor. So how to deal with multiple limiting factor? What is multiple limiting factor? You have shortage of labor hours, at the same time material is shortage, at the same time machine hours are shortage. You need to do linear programming. You need to use linear programming. What is linear programming? Linear programming is a technique through which you can deal with multiple limiting factor and you can find out the optimum production plan. So what exactly we do? We define the variables, that is the products. Then we construct objective function, which could be profit maximization or cost minimization. That is written in the question, right? Then we identify the limiting factor. Shortage of machine hours, shortage of labor hours, shortage of material, and we represent those in form of what? Inequalities. Either that inequality is less than or more than. Then we identify the non-negative constraints. Then we just look at the limiting factor inequalities and we look at the lines of those inequalities on the graph. And after that, what we do, friends, you know what we do after that? After that, from the graph, we find out the feasible area. Feasible area, keeping in mind the inequalities. And after we know what is the feasible area, then we find out the optimum point. What we find, guys? Optimum point. So we have different methods to find out the optimum point. What are the names of the method? One is ISO line. ISO line. And what is the second method? It's inspection method, which we normally say as simultaneous equation method as well, and we find out the optimum point. Now that optimum point could be profit maximizing point or it could be cost minimizing point, okay, depending whatever the objective is written in the question, okay. So yes, we find out the profit maximizing or cost minimizing point. Now there is a very important term which is important for our paper known as shadow price. What is a shadow price? What is slack? What is shadow price? Now let's recall the basic definition of shadow price. Shadow price. Shadow price is the additional contribution earned if one unit of scarce resource becomes available at its original cost. If one unit of scarce resource becomes available at its original cost, that is shadow price. Okay? So remember, guys, when you find out the optimum point, listen, the key words I'm telling you. You have a graph in front of you. Let's imagine there is a graph here, okay? There are different lines here, and you know the optimum point. Now, this is the optimum point, for example, okay? So, you know the optimum point. So, just quickly look at this optimum point and try to see that the lines that are intersecting at this optimum point. It could be this line, it could be another line like this. So the lines that are intersecting at this optimum point are known as what? Are known as critical constraint lines. Are known as what? Critical constraint lines. If these lines are resource lines, what are these? Resource lines, which means there is 100% utilization of these resources. There is 100% utilization of these resources, and this means if these resources are 100% utilized, which means labor hours completely used, material kgs completely used. This means you can work out what? Shadow price. So when there is 100% utilization of a resource, you can work out what, guys? You can work out shadow price. Okay, are you with me, guys? So you work out shadow price when there is 100% utilization of a resource. So when you are working out the shadow price, what you do? What are the steps? Let me tell you the steps. We first identify the optimum point. We look at the equations at that point. Now, if there are resources here, because we work out shadow price for a resource, okay? So we increase the resource by 1. What we do, guys? Do you remember? We increase the resource by 1. And once we increase the resource by 1, we work out the new coordinates. And from those coordinates, we work out the new contribution using the objective function. The difference of new contribution and the original contribution is known as shadow price. So shadow price is the additional contribution if one unit of scarce resource becomes available at its original cost. So it represents the maximum premium that the management can pay. It is really useful for decision making. The other important thing is slack. Now, you know what slack is? What slack is? Just recall slack. Slack is the underutilization of a resource. So very quickly, this is a graph. You can see lines. Just imagine there are lines. The line, one of the material line where optimum point doesn't exist. Or I would say a line where there is no optimum point. So that line is known as non-critical line. What I say? non-critical line, which means the utilization of the resource is not 100%. And if there is not a 100% utilization at this line, there is slack. What is slack? Slack is the underutilization of a resource. When the resource is not used completely, that is slack. So remember, optimum point, the line where optimum point is not there, doesn't exist, that line is known as non-critical one. And that line is the one where slack will exist. Okay? So optimum point lines are critical, 100% utilization, you will work out shadow price. Line where optimum point doesn't fall is non-critical line, which means there is no 100% utilization of a resource, you will work out slack. Agreed? So this is planning with limiting factor. The other technique comes CVP analysis, another decision making and a planning technique. There are 4 important things. Do you know what 4 important calculations are required in CVP? Let me see in the comment section who is writing. So yeah, number 1 is CS ratio. Number 2, break-even point where there is no profit, no loss. 3rd, margin of safety. 4th, target profit. The complexity is when it comes to multi-product situation. So in case of multi-product situation, remember we need to perform average workings. What we need to do, guys? Average working. So what average working is? What is a multi-product situation? Which means more than one products are being sold by the organization. So in that case, if you're required to work out what? Break-even or margin of safety or target profit working. So you need to work out what? You need to work out the average, weighted average CS ratio, weighted average contribution to sales ratio. You need to work out weighted average CS ratio. On the basis of that, you perform the entire calculation. Okay? So remember, in a multi-product situation, always work out weighted average contribution to sales ratio. There are certain graphs which are really important. 3 important graphs. I'll give you a quick recap of that. Just imagine graph 1, break-even chart. Here is a break-even chart. Okay? This is a break-even chart. So in break-even chart, what you see, break-even chart includes a sales revenue line. It includes fixed cost line. It includes total cost line. Okay? Total cost line. So there are 3 lines: sales revenue, fixed cost, and total cost. It shows you break-even point. Second is contribution chart. Okay, what is that? See, this is a chart. You have sales revenue line, straight. You have variable cost line starting from origin. And we have total cost line starting from the point of fixed cost. So contribution chart is very much similar to break-even chart, with the only difference is that in a contribution chart, we have variable cost line instead of fixed cost line. And in a contribution chart, we can easily look at the area of contribution. Agreed? Then comes the third one. What is that, friends? What is that? Profit volume chart. Profit volume chart, multi-product profit volume chart, in which we make a line of profit and loss like this. Profit and loss. So there are 2 lines that you need to keep in your mind. One is line based on constant mix. Okay? And one line is known as line that you make on the basis of highest CS ratio. Highest CS ratio line that we make. So there are 2 lines. Line based on the basis of constant mix, and second line made on the basis of highest CS ratio. So it is known as profit volume multi-product chart. So okay, on the basis of these, we take decisions about break-even. When we'll reach at the break-even, what is our margin of safety, which is your profit area, how many units one need to sell, or how much revenue one needs to earn to achieve the target profit. Then comes very important decision making known as relevant costing. Are you prepared for relevant costing, guys? Say yes or no. So in relevant costing, what are the important things? We have to follow certain rules. What are the rules? I have made this very much clear in my webinars, in my regular session. Rule of 6 is what you need to remember. Rule of 6. What is rule of 6? When a cost will be relevant. Tell me, when a cost will be relevant. Number 1, when it is an incremental cost or it is opportunity cost. Just write in the comment box. It will give you a very good revision, right? So, and just match your answers with other students' answers so that it gets clear that you are writing right. Okay, so a cost will be relevant when it is an incremental cost or when it is an opportunity cost. Okay, now tell me when a cost will be irrelevant. Number 1, when it is a sunk cost, when it is a committed cost. With me, you can revise things very easily, okay? Committed cost. Number 3, notional imaginary cost. Number 4, reapportionment of fixed cost. Because fixed cost is a cost that will remain constant, okay? So rule of 6, Rizwan Maniya, rule of 6 means that a cost will be relevant, either it is incremental or opportunity. A cost will be irrelevant if it falls under sunk, committed, notional, or it's a reapportionment of fixed cost. Now, using relevant costing principles, there are 4 important decisions that we take. Guys, you can see the energy, right? It's a complete performance management in my mind, in this mind. It's complete PM. I'm not watching anything here. It's just a memory. It's just the memory. And this is the confidence and this is the grip I want you people to have over this subject, okay? So let's move on. Now, the first decision is one-off contract. Second is make or buy decisions. Third is shut down. Fourth is further processing decision. What is a one-off contract? One-off contract is a decision in which we know that the work that we are performing is a one-off activity. This is not our regular work. This is a one-off work. This is not our regular work. So we are doing costing for this one-off contract. So for that, we need to use material, we need to use labor, we need to incur overheads. So we look which material cost is relevant, which material cost is irrelevant, which labor cost is relevant, and like this for overheads. So there are different rules that I've mentioned in my regular sessions. There are different rules. Cost that makes material cost relevant, cost that makes labor cost relevant, cost that makes overheads relevant, and all these rules are backed by rule of 6. Rule of 6. So one-off contract. Then comes the second one, known as shut down decisions. What is shut down? First, I'll give you a recap of shut down. Shut down decision is the one in which what should be the mindset? I mentioned this very well in my webinars, in my regular sessions. In shut down, our mindset should be, while doing the costing, while doing the calculation, we will think that we'll close this. We'll think we'll close this. This is not a decision. This is just a mindset that you have to keep in your mind while doing the costing, that we'll close this. Are you getting my point? So, while doing the costing, we'll have a mindset that we'll close this, and keeping that mindset, we'll start doing the calculation. If we close this, this will be relevant, this will be relevant, this will be relevant, this will be irrelevant, this will be irrelevant, this will be irrelevant. And with this mindset, we will do the calculation, and then after we are done with the calculation, we'll work out the net benefit or cost. And we'll see if we are closing this, the net benefit is this much or it's a net cost. And by this we take a decision. So if upon closure you are getting a cost, come on, what is your decision? Tell me. Write in the comment section. If you are getting a cost, if you are closing it, so will you close it? The answer is no. You will not close if you are getting a cost on closure, okay? But if you are getting a benefit upon closure, so will you close it? Yes, because it's a benefit. Agreed? Okay. So shutdown decisions again follow the same 6 rules. Then we have make or buy. In make or buy, there are 2 mindsets. I've covered this again in my webinars and in online regular sessions. Make or buy has 2 perspectives. Make or buy without limiting factor. Come on, write in the comment section. Make or buy with limiting factor. So without limiting factor is a one in which there is no limitation. So what our mindset in that will be? We'll compare the cost of making with the cost of buying. Cost of making with cost of buying, and we'll take a decision whichever is lower. In case of make or buy with limiting factor. Make or buy with limiting factor. So now there is a limiting factor. So what are we supposed to do? VIFHEians, we'll follow steps. What are the steps? Number 1, calculate variable cost per unit. Are you getting this? Calculate variable cost per unit to make. Compare this with variable cost to buy. You get the difference. Saving per unit to make. Divide this saving per unit to make with the limiting factor hours per unit, and you get saving per hour to make. On the basis of saving per hour to make, do the ranking. Now you tell me, if you are getting more saving per hour on one product to make, you will make that product first and the other second, right? So ranking and then make the optimum production plan. So in make or buy with limiting factor, I mentioned this very clearly that in make or buy with limiting factor, we want to make but we cannot due to limiting factor. Agreed? So great. This is make or buy. Now coming towards the last one is further processing decision. So what are we supposed to do here? What is further processing? A decision simply between 2 options. Option 1, whether to sell a product after the split off point at split off, or to further refine the product and sell this after processing. For example, and the best example, you have petrol. So either to sell petrol as a regular petrol, okay, or to refine it and make it high octane and sell this as a high octane petrol. So the difference is between selling at a regular petrol or selling as a high octane. So this is the decision making where you use what? Incremental revenue. What additional revenue you will require when you further process it. You compare that with your additional further processing costs, what cost you will incur, and by this comparison you take a decision whether to further process it or not. So relevant costing decisions are backed by rule of 6. Come on guys, what is that? Rule of 6. Okay, so yeah, that's perfect. Now the other situation that management accountant needs to deal with is risk and uncertainty. Okay, what is a risky situation? Can anybody tell me what is a risky situation? A situation in which you have probability. What is uncertain situation? Situation in which you do not have probability. So a decision maker deals with risky situation and an uncertain situation. As I mentioned, risky situation is the one in which you have probability. Uncertain is the one in which you do not have probability. So guys, there are 4 types of decision makers. Number 1, risk seeker, wants to take more risk. Number 2, risk averse. Oh, not happy taking risk. Okay, goes for a minimum risk, avoids taking high risk. Risk neutral, goes for the most likely result. Sore loser, takes decision on the basis of future regrets. So there are 2 situations, risky situation, uncertain situation. There are 4 decision maker, risk seeker, risk averse, risk neutral, sore loser. Agreed? No. Techniques the decision makers will use in these situations. So listen, risk seeker will use technique known as Maximex. What is Maximex? From maximum outcomes, from the list of best outcomes, select the best one. Risk seeker. Risk averse will use Maxi-Min rule. What is that? From the minimum outcomes, from the worst outcomes, select the maximum one. Sore loser uses what? Mini-max regret rule. What is that? From the maximum regrets, select the minimum regret. Risk neutral will use what? Who goes for the most likely result will go for expected value. That provides you the most likely outcome. Okay? So yes, risk seeker, Maximex. Come on, revise with me. Risk averse, Maxi-Min. Risk neutral, expected value. And sore loser, minimax regret rule. Okay? So, in risk and uncertainty, there are two techniques. One, expected value. Second is decision rule. And decision rule is actually a one that includes Maximex, Maxi-Min and minimax regret rule. Other techniques that are used by decision makers is decision tree. What is decision tree? A tree with different branches, with different sub-branches that helps in taking decision in a situation where you are required to deal with multiple decisions and uncertainties. So decision tree is the one that helps you taking decision in a situation there in which there are multiple uncertainties, and that is decision tree. Then other technique is known as sensitivity analysis. This is one more technique used by the decision maker. So what is sensitivity analysis? This is a technique that identifies the most critical variable. The most critical variable which, if change, will have an impact on the ultimate decision. This is technique number 4. Then comes technique number 5, known as simulation. This is a technique that deals with multiple changes. Okay? Multiple changes. So there are 5 techniques. Come on, revise with me. Expected value, decision rule, sensitivity analysis, simulation, and last one, decision trees. These 5 techniques are known as what? You know, these 5 techniques are known as what? These are quantitative techniques. Like this quantitative, we have research-based techniques as well. Research-based techniques which reduces risk and uncertainty impact. So that is what? That is what? The first is primary research. Second is secondary research. Third is focus groups. These are different research techniques through which we reduce risk and uncertainty. Agreed? Primary research means hands-on experience. Secondary research means get information from other person desk like newspapers, magazines. Okay? Then we have a concept of value of perfect information. So what is value of perfect information? A method through which we work out the importance of perfect information. How much worth that perfect information has. So do you remember the formula of that, guys? Let me help you to recall the formula. The formula is expected value of perfect information minus expected value of imperfect information is known as value of perfect information. Agreed? So entire topic recap. Okay? Then comes the last decision making, that is pricing. It is important for an accountant to set a price. Whenever an accountant sets the price, so accountant considers cost. So options are marginal cost plus pricing, absorption cost means total cost plus pricing, relevant cost plus pricing. So yes, this means our accountant considers cost as an important element for setting a price. Then comes the economist view. Now, who is an economist? A person that considers price and demand relationship. Do we know law of demand, guys? Yes, so we know that. There is a graph. where there is a line. So there is a price and a quantity relationship. So economist sets price considering the relationship of price with demand. So in this we have very important mindset, and that is of setting maximum price. So what are the two methods for setting maximum price? Method 1. Method 1, be with me. Method 1 is MC is equal to MR, where marginal cost and marginal revenue are equal. It gives you optimum selling price. So how we do that? MC is equal to MR. We first form the demand function or price function. What is price function? P, come on, recap with me. P is equals to A minus BQ. I hope all my actions are helping you to recall. P is equals to A minus BQ. Okay? This is step 1. Then step 2, double the gradient for MR. Then using marginal cost, replace MC with MR and find out optimum quantity. And then using this quantity, find out optimum selling price. Are you able to recall the things? Yes. So from this quantity, we find out the optimum price. Guys, getting the point? So this is MC is equals to MR approach to find out the optimum selling price. What is the next approach? Tabular approach. Through a table working, we find out the optimum selling price. That is, we find out different level revenues, we find out different level costs, and we see the price where the profit is highest. Tabular approach. Then coming towards price strategies. Okay. Two types of price strategies are very important for your paper. Come on, do you know what is price skimming? Skimming means charging. Come on, what is skimming? Write in the comment section. Skimming is charging high prices for the product. What are the conditions of using skimming? Number 1, when you know that you can charge high prices because there are barriers to entry, nobody can enter the market. When you know the demand is inelastic. What is inelastic? A change in price will not have a major impact on demand. Charging high prices will not reduce the quantity badly. So condition 1, barriers to entry. Condition 2, inelastic demand. Condition 3, product life cycle is short. Okay? So in these cases, you charge skimming. What is penetration? Charging low prices. When you charge low prices, conditions. Number 1, when demand is elastic, you know that if you charge less, charging lower prices. If you charge less, you'll get big market. Demand will react. Condition 1, demand elastic. Condition 2, when you want to capture a bigger market share. Condition 3, when you need to quickly move towards growth and maturity phase. My friends, management accountants, remember in examination, you need to cover up the conditions. You need to keep conditions of these in mind. In a scenario, you need to tell which strategy is useful. So, as I mentioned, penetration, 1, elastic demand. 2, quickly move to growth and maturity. 3, want to capture higher market share and discourage competition. Okay, so these are the decision making techniques, and I have made this clear up till now. I hope this summary is helping you. This summary is helping you a lot, and almost this part has been completed. Almost we have completed 60% of the course. What's your feedback up till now? Are things going good? If you are happy, please, before this break, just comment in this comment section as to how you think things are going. I'm giving my best. You can see my energy, my voice, constantly speaking, just for you people. I hope this is helping you a lot. Please give your feedbacks on the comment section. Please give your feedbacks in the comment section. Now, having said that, there are 3 things that are done by the management accountant that is planning, controlling, decision making, there are certain techniques I would say that management accountant is also using in this modern environment. And as you all know that the manufacturing environment has changed. Now we are moving towards the more advanced techniques. Yes, we need to keep in our mind that previously it was very much labor intensive environment. Now it has changed to machine intensive environment. It's a machine intensive environment now. So there are certain techniques that are used by the management accountant keeping in mind machine intensive. Now what change machine has brought in the market? So yeah, it's a major change because it's machine intensive environment, which means that labor usage has gone down. You need machine operators, you need fuel for the machine. So this means your indirect costs have increased. In short, your overheads have become significant. So that is why you need to change your techniques, and the first is activity-based costing. ABC versus which one, guys? Can you write in the comment section? Absorption costing. Yes, ABC versus absorption. ABC absorbs the overheads into product cost. Absorption costing was doing the same. But what is the difference? So the difference is a major one. And the difference is ABC is absorbing on the basis of production related activity levels and as well as non-production related activity levels. But when we say absorption costing, so absorption was absorbing just on the basis of production related activity levels. Now if you want to know what is production related activity levels, so it means direct labor hours, machine hours, number of units. So ABC costing uses production, the three I mentioned right now, whereas non-production ones like number of inspections, like number of setups, like number of material movements. So how do we follow ABC? What are the steps? The steps mnemonic is 2C to A. I repeat, 2C to A. What is first C? Cost pool. Second C, cost driver. First A, absorption rate. Second A, absorb. So if you need to remember the mnemonic of ABC costing steps, so what are that? 2C to A. Okay. Now, why ABC is more beneficial than absorption? What are the advantages? So remember, ABC advantage 1. Come on, recap with me. Fair allocation. Okay, fair allocation. Number 2, it is useful in machine intensive environment because overheads have become significant and ABC results in better allocation of overheads. Remember, if overheads will be accurate, your costs will be accurate and your price will be accurate. So, fair allocation, machine intensive environment, it's useful in that. Number 3, ABC is very useful for controlling overhead cost. Why? Because ABC believes that overhead are of variable in nature in long run. Which means if you reduce number of inspections, your inspection cost will go down. If you reduce number of setups, your setup cost will go down. So yes, ABC says in long run overheads are of variable nature. Getting the point? But what are the drawbacks of ABC? So the disadvantages includes it is time consuming and costly activity. Yes, exactly. You need to break the overhead into cost pools. For every cost pool, you need to find out cost drivers. Secondly, you might not get a realistic relationship between cost pool and cost driver. Yes, because there are certain overheads like general overheads that do not have respective cost drivers. Okay. The third problem of ABC is that ABC requires an implementation of a system. ABC requires detailed accounting system. a system that is capable of breaking overheads into cost pool and cost driver. So you need to train the people, you need to implement the system, and maybe the cost might exceed the benefits. Now, if you ask me why a cost will exceed the benefit, so my answer here will be, sometimes if an organization is a one where overheads are production related or overheads are insignificant. So if the overheads are insignificant, there's no use of using ABC. If overheads are insignificant, again there is no use of using ABC because overheads are not that much. And if there are production related, so it's better to use absorption costing, because absorption costing is absorbing on the basis of production related activity levels. Okay, so these are the negatives of ABC. Another technique that comes after ABC is target costing. Target costing is a cost reduction technique. How does it reduce the cost at the development phase? So what it does, the steps of target costing, what is the shortcut, what is the mnemonic? So remember, it's MDTC square. MDTC square. M is market price determine. Number 2, desired profit figure out. Number 3, target cost calculation. Number 4, current estimated cost calculation. Number 5, target cost gap identification. So it's MDTC square. So my friends, my management accountants, remember that target costing is a cost reduction technique. Target costing is what? It's a technique that reduces the cost when the product is in its development phase. You haven't made the product, but you are reducing the cost in the initial phase by comparing current estimated cost with the target cost. What is a target cost? A target cost is a cost that you should achieve. What is a current estimated cost? A cost that you will incur if you make product right now. So you need to reduce the current estimated cost to target cost. And this is known as feed forward control. So how do we reduce the cost gap? There are different ways. What are the ways? Let's discuss the first three simple ones that are easy to remember. Reduction of material cost, reduction of labor cost, reduction of overheads without compromising on quality. Very simple 3 points. Then comes the next 3. You can reduce the cost by economies of scale. You can reduce the cost by moving from labor intensive to machine intensive environment, because machine is more effective, efficient, will reduce the cost. And the third is what, guys? Value analysis. What is a value analysis? Value analysis means that focus on value adding items and eliminate non-value adding items. Agreed? So yes, these are the ways to reduce cost gap. Now, how beneficial is target costing for an organization? Number 1 advantage, it gives you the advantage of setting a market price because you conduct a survey. Number 2, it gives you a big advantage to reduce the cost in the development phase. Number 3, it helps you to incorporate customer requirements at the development phase because you do a survey. Okay, so definitely it is very much advantageous for an organization. Then comes life cycle costing. Now, what does life cycle do? Life cycle costing. If I say life cycle costing, so what comes in your mind? Entire life cost matched with entire life revenues to measure the true profitability of the product. So remember, examiner can confuse you here. When I say entire life cycle cost, so it includes recurring costs, it includes non-recurring costs, it includes all the type of cost, okay? Whether it pertains to the current year or it pertains to future years. which includes your environmental cost as well. So life cycle costing gives you the flexibility, advantage of taking right decisions at the initial phase. How? Because you compare the entire cycle revenue with the entire life cycle cost and you can take a decision. It's a planning technique. People think this is a controlling technique. No. At the planning phase, you work out entire cycle revenues, you match that with the entire life cycle cost, you measure its true profitability. So it helps. Advantage number one, it helps you in taking right decision. Advantage number two, through life cycle costing, you are able to reduce the cost at the early phase. Now, products in relation to which we can say that their major cost is incurred in the initial phase, around 80 to 90%. So, life cycle costing gives you the opportunity to match that cost with the revenue and take decisions in order to reduce the cost in the early phase. Plus, life cycle costing is very useful for products that have a short life cycle. Now, why? Because short life cycle product means that it's easy for you to estimate. It is easy for you to estimate their revenues and cost. Okay, so this is life cycle costing for you. Then comes throughput accounting. Throughput accounting versus what? Marginal costing. There is a concept known as theory of constraint, which says that every organization is facing with a limiting factor. So, to deal with the limiting factor, you have throughput accounting. Throughput accounting is based on three concepts. The first is throughput. What is throughput? What is the definition of throughput? Come on, recap with me. The definition of throughput is rate of converting raw material into finished goods sales. The focus is on selling, not on holding as inventory. Okay. What is the formula of throughput? It's selling price minus all material costs, where material is the only variable cost. So my friends, throughput assumes material to be the only variable cost. Agreed? Then comes the next one. The next concept is of operating expenses. According to throughput, operating expenses includes direct labor cost. Come on, are you getting the point? Number two, variable production overheads and fixed production overheads. And it assumes all these to be of fixed in nature. So it assumes everything to be a fixed cost known as operating expenses in short run. The third concept of throughput is very important, that is about inventory. Throughput says that there should be no inventory, or if you need to keep, it should be low inventory just to support the limiting factor. So throughput believes not having inventory. It says that the focus should be on selling inventory, not on holding the inventory. That is why throughput value inventory on material cost. My friends, throughput accounting has two types of calculations that can come in your paper. Calculation 1, work out throughput accounting ratio. What is the formula? Let's recap the formula. The formula is throughput per hour of limiting factor divided by operating expenses per hour of limiting factor. If the answer of throughput is more than 1, if the answer of throughput accounting ratio is more than 1, it is feasible to make the product. If it is less than 1, it is not feasible to make the product. Are you getting the point? Yes. So, if someone asks you, what are the ways to improve TPAR? Your answer will be what? Your answer will be Rizwan Maniya's shortcut mnemonic, named as MOST. M-O-S-T. M stands for reduce material cost. O stands for reduce operating expenses. T stands for reduce the time to make each unit. S stands for increase selling price. Okay, so the mnemonic is MOST: material, operating expense, selling price, and time to make each unit. The other type of calculation that can come in the paper is multi-product decision making, where you may be required to compare throughput with single limiting factor, with key factor analysis based on marginal costing. So if you are required to compare, so remember in throughput, first we work out throughput per unit, then we work out throughput per hour of limiting factor, then we will rank in multi-product situation where there are more than one products, and based on our ranking, we'll prepare optimum production plan, which will tell me that how many units I need to make. If I am required to compare this with the approach of marginal costing known as key factor analysis, so in that what I will do is that I'll work out contribution per unit, okay? I'll work out contribution per unit, then I'll work out contribution per hour, then I'll work out on the basis of this, I'll do ranking, and then we'll make optimum production plan. So there might be a question where you are required to make optimum production plan using marginal costing, known as key factor analysis, and throughput accounting. The last we have is the environmental management accounting. So before I move towards environmental, I want to tell you one thing. In throughput, it is really important that you know how to find out limiting factor. Either the limiting factor might be given, but if it is not, then you have to find out using different techniques, okay? Environmental management accounting. What is environmental management accounting? It's a very simple concept which says that the management accountant of an organization should be able to understand the environmental consequences its organization is doing and should try to reduce it, okay? So where is environmental cost hidden? Do you know that? Come on, you can write in the comment section. Where is environmental cost hidden? It is hidden in overheads. It's hidden in overheads, okay? So there are two types of environmental costs. One is internal environmental cost which is paid by the company, and second is external environmental cost which is paid by the society, okay? So there are four methods of accounting for environmental cost. The first is flow cost accounting, which basically tells you the entire flow that the material passes on, and it tells you how we can reduce the material quantity, which we have covered in our regular online classes in a very detailed way. Second we have is input and outflow analysis, which is a reconciliation between the quantities of input with outputs, and through this reconciliation you figure out your wastage and you can reduce that. Third is environmental life cycle costing, which says that life cycle costing, when you accumulate the entire life cycle cost, you should consider environmental cost as well, like decommissioning cost relating to a product, like dismantling costs that will be incurred at the end of the product life cycle. So you should account for that as well. Then comes the fourth one, environmental activity based costing. So it says that ABC, when you break the overheads into cost pool and cost drivers, so you need to identify environmental cost pools as well. Cost pools relating to the costs that are hidden in overheads, that are environmental costs. So you have to make environmental cost pools as well, and for that find out environmental cost drivers as well, so that you are able to control the environmental costs. So these are the techniques that are used by the modern management accountant considering machine intensive environment. And the last work now the management accountant performs is performance evaluation. Okay, so this is a very crucial section. This is the heart of performance management. This is the most important for your paper. This is a one that is tested in constructive response area for 20 marks, and it also comes in section A and B, performance measurement. This is the fourth work that is done by the management accountant. Do hear very carefully. Whenever a management accountant is asked to evaluate the performance of an organization, the management accountant uses financial indicators and non-financial indicators. What are financial indicators? Financial indicators include financial ratios. Now, can you name the ratios? Let me do it for you, okay? Number 1 is percentage increase in sales growth. Number 2, percentage increase or change in profits. Number 3, return on capital employed. Number 4, asset turnover. Number 5, operating profit margin. Number 6, gross profit margin. Number 7, net profit margin. Number 8, financial gearing. Number 9, operational gearing. Number 10, interest cover. Number 11, interest gearing. Wow. Number 12, liquidity ratios include current ratio, quick ratio, inventory days, receivable days, payable days. These are financial performance indicators. So remember, when you management accountant are required to assess the performance of an organization, you can use financial indicators. But you cannot ignore non-financial indicators. These are very important for the future of an organization. Non-financial are forward-looking. These are historical. Non-financial covers the qualitative aspects. They only covers quantitative aspects. Okay? Non-financial are less subject to manipulation, whereas these are more subject to manipulation. So non-financial indicators example includes number of repeat customers, percentage sales return, number of innovative products developed. These are non-financial ones. So yeah, it is very important to consider non-financials along with financials, and for that we have models named as balance scorecard. Wow, what a great way to revise everything, right? Balance scorecard. Number 2, building block model. Balance scorecard is a model that says that there are 4 perspectives and whenever you are required to assess the performance of an organization, you need to consider 4 perspectives. Balance scorecard was developed by Dr. Kaplan, Dr. Norton, which considers these 4 perspectives are important for an organization vision achievement. So it says that if you want to achieve your vision, there are 4 perspectives you should focus on. Perspective number 1, financial perspective. It covers the shareholder wealth maximization. Perspective 2, customer satisfaction. It focuses on customer satisfaction. Perspective number 3, internal efficiency. It focuses on the speed of the business processes, the productivity of business processes. Number 4, it says learning and growth, which is innovation and learning. It focuses on future development of an organization. So it says that balance scorecard, if you use balance scorecard for assessing the performance of an organization, you will cover both financial aspects and the non-financial aspects. Getting the point, guys? So yeah, balance scorecard is important. Then comes building block model. Building block model. It is useful for service business. So can you tell me why building block model is useful for service business? Because it focuses on 6 dimensions. How many, guys? 6 dimensions. Come on, name it. Number 1, financial performance. Number 2, competitiveness. Number 3, flexibility. Number 4, resource utilization. Number 5, innovation. Okay. Number 6, quality. So there are 6 dimensions. Now, from these 6 dimensions, the first 2 which I mentioned are known as resultants. Financial performance and competitiveness is resultant. And the last 4 that I mentioned are determinants. Quality, resource utilization, flexibility, innovation will determine how will be your results, how will be your financial performance, how will be your competitiveness. Okay, so these are resultants, the first 2, and the last 4 are determinants. Now, when you are assessing the performance of a service business like a bank, like a distribution company, like an education institute. You have to use building block model. And when you have to use building block model, you have to assess these 6 dimensions. Okay. So for these 6 dimensions, you will use KPIs. What are KPIs? Key performance indicators, which I've already mentioned. Financial key performance indicators and non-financial key performance indicators. Okay. So through financial KPIs and through non-financial KPIs, you can assess the 6 dimensions of building block model. You can assess the 4 perspective of balanced scorecard. Further, moving towards building block model, it says that when you are setting these KPIs, you need to set targets for these. You need to set standards for these. So when you are setting standards or targets for these KPIs of financial and non-financial, remember you need to consider ownership. Remember you need to consider achievability. Can you recall? Remember you need to ensure fairness when setting targets for these standards. And the last block says that because service business is people-oriented business, you need to give them rewards to achieve the targets. You need to give them rewards to achieve the standards. So those rewards when you set, keep in mind, number 1, clarity. Number 1, control clarity. Number 2, motivation. Number 3, controllability. So this is building block model. Okay. Now, having understood how to assess the performance of an organization overall, then we come towards divisions. Division of an organization. So, division A, division B, division C. So, how to check the performance of the division? We have 2 very important indicators known as ROI and RI. Return on investment and residual income. Are you getting my point, everybody? So, ROI and RI are those indicators that are useful for measuring the performance of a division. Now, listen one by one. For assessing the performance of division, ROI is useful. Yes, because ROI is a relative measure. Remember, relative measure. It is useful for comparing division 1 with division 2. So when assessing the performance of division, ROI is useful, whereas RI is not useful. It's a very quick summary. RI is not useful. Why? Because RI is an absolute measure. It is not useful for comparing different size divisions. Agreed? But when assessing the performance of a manager, ROI is not useful. ROI is not useful because manager will try to achieve ROI and will manipulate the results. It will result in dysfunctional behavior. Manager will prefer its own objectives. So when assessing the performance of the manager, listen, RI, residual income, is preferred over ROI because residual income is an absolute measure. When you work out RI, you use cost of capital, which means cost of capital is linked with shareholders. So when manager try to increase RI, this means they try to achieve cost of capital. And when they try to achieve cost of capital, this means they are covering shareholder wealth. So assessing manager performance on the basis of RI results in goal congruence, results in wealth increase for the shareholders. That is why third point is about shareholder wealth. So when asked which measure is better for shareholder wealth, so the answer will be RI is better for shareholder wealth compared to ROI because RI uses cost of capital that is linked with shareholder wealth. Then aging of asset. Which one gets affected by aging of assets? What is aging? Asset is getting older and older and older. So remember, as the asset gets older and older and older, and you are not replacing that asset, which means both ROI and RI results tend to increase. Both will increase. And if the managers are getting bonus on that, so both wages will increase and managers will receive unjustified bonuses. So aging, as asset gets older, both results starts to increase, and that may result in unjustified bonuses. So it's important to consider the impact of manipulation. The last thing is controllable, which means for assessing the performance of the managers, you always have to take what? Controllable profits. You always have to take controllable assets. What are controllable? Something which is in the control of the managers. Something which is in the control of the managers. Something for which manager took the decision is controllable. Agreed? So the summary is very much simple. For division performance assessment, ROI. For manager performance assessment, RI. When we talk about wealth creation, RI. When we say aging of asset, both gets affected. When we say assessing the performance of the manager, we should take controllable figures. Wow, awesome summary, awesome recap, right? Now, when we say division's performance, so division's performance gets affected by business that they do as well. So yes, there is a possibility that that divisions are doing business with each other. And when one division of a company is trading with other division of that company, so the price at which they do the business is known as transfer pricing. Yes, transfer pricing. So it is very important to determine the right transfer price. For that, we have a rule known as general rule. General rule. What is general rule? Marginal cost plus opportunity cost. So if you want to set a transfer price that doesn't result in a conflict, that results in a fight, so theoretically, general rule is the best rule to find out the transfer price. If nothing is mentioned in the examination and you are required to tell the price, the best price to achieve profit maximization, it's none than the other known as general rule, where you will look at the marginal cost of the seller, marginal cost of the seller and the opportunity cost. So whenever you are faced with a transfer pricing question, my friends, remember that in transfer pricing question, there is important to find out buyer and seller. And if I just give you a quick recap, I've mentioned in my regular online batches that there are three types of questions that can come in the paper. Different categories I've mentioned, that categories that one can keep in mind when solving transfer pricing question. This is something I've done through the research. So you might be asked to work out the divisional profits. You might be asked to find out state the transfer prices. Okay. So there are different types of questions that are tested and general rule can be used. Then another option of transfer price based on more practical aspect is market-based transfer price. Market-based transfer price is the one that will not result in any fight. Okay, if question is mentioning that you have to use market-based transfer price, so you have to use the market price, and that acts as a fair transfer price. But remember, when market price will not be useful, when the seller is in a monopoly position, or the prices published in the market are fictitious, are not real prices. Okay, so in that case it will not be useful. But when you don't have market-based price available, so you have to go for cost-based options. And what is cost-based option? That is, you're setting transfer price on the basis of cost. But remember the rule of thumb. The rule of thumb is, whenever you're setting transfer price on the basis of cost, it should always be standard cost. It should always be standard cost. It should always be standard cost. You can't take actual cost. So what are the options of cost-based? Number one, standard marginal cost of the seller, which will not give seller the contribution, okay, and will result in loss. Second option is standard total cost of the seller, which will ensure the seller is at break even, but again, seller being a profit center will not agree to this. Third standard total cost plus profit is the best option, which will give seller the profit as well. So my $1 million point here, my $1 million technique that I mentioned in my regular classes was that if a question comes where it is not mentioned how to work out transfer price, use general rule. And when you use general rule, what you need to remember first is the seller's perspective. Find out transfer price using seller's perspective. That will give you minimum transfer price, okay, using general rule. Then considers the buyer's perspective. That is the maximum transfer price. Remember guys, buyer's perspective. And then the last is the group perspective, that from group perspective, what is the range of transfer price, and then recommend that range of transfer price, and that will be the optimum range of transfer price. Okay, so these are the techniques. These were the $1 million techniques that I told you in my different sessions of webinar of ACCA, and as well as in my regular online classes. And this is the summary by Rizwan Maniya, performance management paper in one slide. Come on guys, what's your feedback? Write in the comment section. Do you like this small effort of Rizwan Maniya? I hope you like the way I just gave you the recap of the entire paper and the connection in 4 points. What are those 4 points? Planning, controlling, decision making, and performance evaluation. So this is performance management in one slide by Rizwan Maniya. For you people, it's a small gift that I'm giving to my management accountants, those who are appearing for this very tricky paper. Use this slide and take best of it, and remember Rizwan Maniya and VIFHE in your prayers. Okay, so I hope you like this technique. I hope you like the summary. I hope you like my energy, my effort. Please do give your feedback in the comment section below. I want everybody to give the feedback. If you think I've made a justified effort, if you think this summary will be useful for you, so please, the only return I need is your feedback. It's your feedback in the comment section that did you like this summary? I know this video is a long video, but yes, this will be very effective one for you before the paper. If before the exam you're watching it again and again, maybe 2 times, the entire summary will be with you in your mind, in your paper. If you are not part of my WhatsApp group, please, this is my WhatsApp number. Do send me WhatsApp message at this number, and I will give you my group link, and you can be part of my groups so that you get the support relating to performance management, and you will remain active in my groups every time, and you'll get the updates what I'm doing in the coming sessions of performance management. So this is my WhatsApp number. I hope you all will send me the message when you want to be part of the group. And yes, please, I need your feedbacks in the comment section. I hope this small effort of Rizwan Maniya using VIFHE platform will help you to ace in your performance management paper. Remember my words, my friends. Remain positive. If you work hard, you will not fail. This is my belief. This is my belief, honest belief. You work hard, God will help you. God will never disappoint you. And if there is some issue, if you get failed, so maybe this is not the better time for you, and you might need to come up with other strategy, and that attempt will be your better attempt. Okay, so remain positive. If you have your parents in this world, ask them to pray for you, because the prayers of parents is extremely important for the success of the exam. And remember, it's just an exam. Just be tense-free and give your best in the examination. So yeah, I hope the entire session went well for you people, and you did like this bird eye view of performance management, AP performance management in one slide. I hope you like F5 PM in one slide. So yeah, I'll be waiting for your comments in the comment section, and best of luck.